Hello, everyone, and welcome to the Daniel Krug and Associates September Market Update. And we're going to be talking a little bit about the market and about the recent Fed rate cut. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel Krug, CEO and Senior Wealth Manager, will be joining me in today's presentation. We want to thank our portfolio research groups, especially City National Rockdale, for providing a lot of the data and information we are presenting today. To get started, I want to recap our monthly leading economic indicators. We go over these every month. They're represented by green, yellow, and red dials. The green means the indicator is moving in a positive trend. If it's yellow, it's neither positive nor negative, kind of neutral right now, and red means it's a negative trend. As you can see on the left side of the chart, in September, we're seeing some improvement on the top line in monetary policy. We're going to be talking a little bit more about the first rate cut we've had from the Fed in a while. Also, we're seeing some improvement in the yield curve. Both of those boxes are highlighted. Again, the yield curve is still yellow, but it's getting pretty close to a normal yield curve. And what a yield curve is that when longer term interest rates are paying a higher rate of return than a shorter term rate, that's a normal yield curve. You would expect to get a better rate of return, higher rate of return for a longer term bond than you would a short term bond. And that wasn't the case over the last couple of years because of the amount of increases in the Fed rates due to inflation, so on and so forth. But we're seeing a lot of normalizing coming back into the schedule. And when you look at August on the right side of the chart, you can see how where we were a month ago, we're starting to see a little bit more improvement, even though the economy is still slowing. We think we're coming towards a bottom here. We don't believe there's any kind of recession in sight. Everything is looking good to shape up for maybe about a 1.5% growth rate in the GDP for this year. So overall, economically, we think things look pretty sound right now.
Well, you know what? You talked about the yield curve, and this is interesting because yield curves, treasuries, Fed rates, mortgages, how do they all kind of play together? And we'll talk a little bit about that as we get going here. Yeah. But before we go there, let's look at this. We're going to talk a little bit about what's going on with AI and the markets right now. You know, when you look at this chart on the left side, you'll see some of the major indices basically and the returns year to date, 1 year and 3 years. And you can see pretty much everything is running the way it's supposed to be. So in other words, we're kind of running on all 8 cylinders right now. Even with the US aggregate bonds, they are looking pretty sweet currently. Now, let's not forget, we are still in a secular bear market for bonds. So do we expect that to stay up at that 5% level for the next year, 2 years, 3 years? Probably not, based on the trends. So we'll be keeping an eye on that. One of the things that have really shot up is gold. You can see it over the last year is up 31%. And actually, it's starting to surge again at this point. It based out a little bit over the last 3 or 4 months, and it just made another push upward. And so too did silver. The other surprise is really international development and emerging markets, which have really pushed forward greatly year to date. So one thing you will see in a lot of the portfolios is there is a shift from US, not completely, just a little bit of a shift out of US and into international development or developed countries and emerging markets. One of the things that you also want to kind of look at when you're talking about the markets is the right-hand side of the chart. And that is the S&P 500. It is still being powered by tech earnings. And one of the reasons for that is really the AI revolution. As everybody has heard, the reality is these big tech companies have got the money and they're really pushing hard for AI to drive their businesses moving forward, not just in the next year, but in the decades to come. So there's a big push there. And when you think about the S&P 500, the green line there represents the price of the S&P 500 from 2015 to 2025. Been a little volatile, but certainly has been very profitable. You look at the earnings, which is the dark blue for the tech sector, and you can see that's driving up just like the S&P price is. But the interesting thing is when you look at the earnings for the rest of the S&P 500, which is the aqua line there, you can see that's not quite performing as well. It's not performing bad, as a whole, but it's just not where the tech stocks are right now. So again, this year, you're going to see a big push in the S&P 500, which is going to be led or is being led by the tech stocks. Now, we're going to look a little bit at policy sequence, really looking at where we are from an economy standpoint. And I've got listed here really 6 different areas from trade down to regulation and what's going on in those areas. When you look at position, for instance, with trade, you can see that there are higher tariffs right now. There's been a big push this year to increase tariffs. And you might ask, well, how's that going to affect growth and how's it going to affect inflation? Well, growth, as you can see, is going to be inhibited a little bit because of tariffs, and inflation is going to increase a bit because of tariffs. Now, what I find real interesting is the way the news is portraying everything. And that is when they talk about trade, they lump all of growth and all of inflation in with their conversations. And the problem is the trade isn't going to drive the entire economy relative to growth or inflation. And what we're seeing here on this chart is, yes, trade and also immigration laws that are being enforced are going to have a negative effect on growth, at least in the short term. And it's also going to have a negative effect on inflation. However, when you look at the other 4 areas, we're looking at either neutral to growth or higher growth relative to fiscal spending, taxes being lowered, energy policy. The way they've enacted it is actually lowering energy costs. And then regulations for businesses are also lowering costs. So what does that mean for inflation on those 4 categories? Well, fiscal and tax would probably be neutral, but energy policy and regulation is actually going to be lowering inflation. And we've talked about this in meetings with our clients that even though the trade and the tariffs is going to be inflationary for those goods, it's not for the entire GDP for the United States. So it's actually looking out pretty positive. Even though things might be slowing down a little bit now, we are setting the stage for higher growth and actually neutral to slightly higher inflation moving forward in 2026. And this chart really kind of helps you understand the inflation and what areas are actually being hit and how shelter and energy is actually offsetting the tariff hikes. This chart here on the left, this colored chart, really kind of shows the services, food, goods, and energy and how it is impacting inflation. And it goes back all the way to December 2020 when inflation started going up, and then August 2022 when it hit its high. And you can kind of see in August 2022, the 3 biggest areas that were being hit were energy, goods, and services. Everybody talked about the food because we're always going to the grocery store and seeing those numbers creeping up on us. But the biggest portion was services, energy, and goods. Now, kind of fast forward to today, and where's the biggest culprit for inflation? Well, most of it is services because wages are going up. And because wages are going up, the cost of services are going up as well. So that's the biggest part of the inflation driver. And then you have the food, which is still higher. So that's the second largest. And then you've got goods. But look at the bottom of the chart for 2025 there. Energy prices are actually going down. And that, again, drives a lot of the other prices out there, keeping them a little bit more under control. And then on the right-hand side, the impact of tariffs on inflation. Well, if there's 100% pass-through, which is not happening right now, and no one anticipates that happening, it would have a much greater effect on inflation overall. 75% pass-through, which is the, gosh, what would you get? Like fuchsia, purple?
Yeah.
I mean, what's that color? Okay, we'll call it purple. 75% pass-through is still pretty significant, but what they're thinking more is closer to 50% pass-through or somewhere between 50 and 75%. Again, going back to where we think that's going to affect inflation and growth, short term, it's going to affect it for sure. Longer term, not so much. Now, let's get on to the Fed and the rate cut and mortgages, because many people thought, hey, the Fed's cutting rates, so mortgages should be going down. But is that actually what happens out there? As we all know, the Fed's lowered the rate by 25 basis points, so the new Fed rate is between 4 and 4.25. But how is that affecting the mortgage rates? Well, actually, there was a little bit of overexuberance where many of the companies out there actually started lowering rates a little bit ahead of the Fed cut. You know, whether they were trying to drive additional sales or whether they were just thinking it was going to go down, I think they know better. So it's probably trying to drive sales for the mortgages. But at the end of the day, the Fed rate cut didn't lower the rate like everybody thought it was going to. And one of the reasons is we have stronger than expected economic data. And probably more importantly, is the 10-year Treasury yield is going up. And the one thing most people don't understand, and we haven't really heard it too much in the news, is that the mortgage rates are actually driven more by the 10-year Treasury yield than the Fed's. And this chart kind of shows what happened this week. You know, the Fed rate cut was done on the 17th, and the Treasury yields actually went up. And if you've been following the mortgage rates, you'll see after that date, the mortgage rates started to go up as well. It's kind of interesting, but it's not playing out the way everybody thought it was going to.
I think a lot of that, to explain it to our clients, is that there's other factors involved in what determines the 10-year Treasury rates and yields. And the biggest one is supply and demand.
Yeah.
So if there's too much supply, the Fed or the government has to raise the rates that they're willing to pay in the future to get people into buying bonds and treasuries. So, you know, this takes a little bit of a while for the Fed's overnight rates cuts to be impacting other market sensitive, demand supply sensitive type instruments out there. So you don't see mortgages moving a lot. You don't see auto loans moving a lot. And I think, I think there's going to be other incentives out there. You know, mortgage companies are competing for your business.
Yeah, they are.
So, depending on if home sales continue to slow, which they've done overall, that makes the market a little bit more competitive.
Yeah.
If auto sales slow, that makes the market a little bit more competitive. So you may see incentives from different companies, but it doesn't necessarily guarantee an across-the-board reduction in those type of loan rates.
Yeah. Well, I'm actually seeing that as well. So my lease is up, and I've got to get a new truck. And what I'm seeing out there in rates for new cars is about 2.9 to 3.9, which is not bad, and it's certainly lower than the market. But again, it's like you said, they're trying to drive the sales of the cars right now.
Right, and sometimes it's specific to the vehicle. If they're not selling it, they'll offer incentives on a specific model, not across the board.
That is true. And I wonder why the trucks aren't selling as well as the prices have skyrocketed so much.
Yeah.
I mean, I just can't believe how much more expensive a truck today is than it was 3 years ago.
Yeah.
Exorbitantly higher, which I guess begs the question of whether you should lease or purchase a truck,
Right.
which is actually something I'm looking at right now is which one do I really want to do here?
Yeah.
So good things.
Yeah, I think things look pretty good. We just give an overall to the economy. Yes, it's slowed down a little bit. We're seeing things in the news that the labor market is softening and things like that. But I think
Yeah,
overall,
I just think that's crazy when they say softening because it makes it sound like it's soft.
Yeah, well,
It really isn't.
No,
just try to hire somebody right now.
Yeah, and I guess it's the good news is we're not, laying off tens of thousands
True.
of people.
True.
This is a little bit more selective. I think companies have learned, hey, it's better to hold on to employees
Yeah.
if they can see the next year or two that revenues, profits are looking good.
Yeah.
Why give up a workforce and then have to retrain them?
Right.
They're willing to, ride this through. So I think this slowing in the labor market is going to, come to an end, and we're going to see things start to pick up next year. A lot of our economic forecasts for next year are better than this year.
Yes.
That's another reason the market, I believe, is staying where it's at. Everybody's like, I'm not focused on today. Where do I think things are going to be a year or two down the road?
Right.
And it looks like everything's improving in those 12 to 24 month forecasts. So,
Yeah. So all good.
yeah. Okay. Well, let's kind of wrap things up here. Just a reminder for you people who want to watch or see some of these replays, go to our website, mydkna.com. Click on Watch Us. We got it highlighted here. Then go to DKNA YouTube, and you will see all of our videos out there, our webinars, a lot of different ways to get the information you need. There's no need to worry. We're ready for 2025 and beyond. Have a good day.
Yeah. Have a
Good
great
seeing
weekend.
you guys, and we'll be talking with you soon.